Our next guest thinks now may be the perfect time for some strategic profit-taking. Alan Lancz, president of Allen B. Lancz & Associates, editor of the Lancz Letter. Good morning, Alan. Good to see you.
Good morning, Mark.
Cut and run? Is that what you're saying?
No, I think the market has further to go, but it's smart to start taking some profits and not chase stocks indiscriminately here.
Alan, you say if we're going to look at the number one factor for the markets in the second half, forget oil, right? Forget private equity. Forget it's going to be interest rates, right?
Yeah, interest rates. I mean, that's why we were so bearish last month, Carl. Interest rates went up even higher than we expected the first half of June. And I think the trend of interest rates is going to dictate as far as what stocks do the second half.
How bearish does that make you going into 2H?
Well, I think basically what the month of June did is it put risk back in the investors' equation. Before, I think we had one down month since May 2006. So now that investors are looking at the risk equivalent with the subprime loans, with interest rates going up, with higher energy, it's a situation where you're going to have more volatility. You're going to have these 100-point swings, etc. So I think the smart investor takes advantage of those swings, and you know, those glory days of being up every month are going to be over.
Alan, what do you think? Is the market? Are they more immune to rates than maybe even you think?
Yeah, I think we are. I think there's a record number of bank loans out there. Some of the covenants aren't as disciplined as they should be. 2006, we had a record issuance of high yield debt, and 2007 year to date, we're on pace to break that record. So obviously, even interest rates at 5.25 is problematic. And I think you know, you add in the subprime loan problems and the hedge fund derivative problems, and you know, like I said, risk is back in, so you're going to have these volatile days. If interest rates go down as low as Ned thinks, it'll be a good period, but I don't think interest rates are going back down to 4.5.
Ned, you're actually looking for some.
Okay, we're back. Our next guest doing the opposite of what most investors are doing. Joining us to explain is Alan Lancz, president of Allen B. Lancz & Associates, editor of the Lancz Letter. Alan, good to see you again.
Thank you, Mark.
First of all, how do you figure out what most investors are doing these days? This seems like a manic, back and forth, up and down, volatile market.
Exactly. The volatility has been extreme, and I think it's just a matter of taking advantage of the extremes. As you know, in May we were talking about reducing risk and getting into larger cap companies with global presence and solid balance sheets to take advantage of their competition. Well, it seems like in the last 3-4 months, we've had that flight to quality and more investors doing that. So companies we talked about like last time, like Novartis, Sanofi, Aventis, have gone from new lows to nearly all-time highs. And we would avoid that. So that tells me, where the money's going, and I would not chase that money. Also, technology. A lot of investors are buying technology. It was a flight to quality type situation because they were avoiding subprime, etc. The high flyers in technology, it just didn't make sense because the ripple effects of subprime and the credit crisis is going to affect the consumer, and that's going to affect those high flyers. So we took profits in some of those type of.
Alan, I know you were negative on technology, but you're actually looking at the opportunities in this group right now, correct?
Yeah, I think there's some good opportunities, Maria. You look at an EMC or for a speculative investor, Palm. I mean, the expectations are so low that I think there's a good chance that investors over the long term can make some money. So where we were negative on tech in the fourth quarter when everybody was buying it because they're unrelated to subprime, they've gone down enough, even like a Google and an Apple, where they're starting to look interesting.
Joining us now with his second half strategies on large cap versus small cap investing, Alan Lancz, president of Allen B. Lancz & Associates and editor of the Lancz Letter, joining me today. Good to have you on the program. Welcome, sir.
Thanks, Maria.
So is there any reason to believe that this relationship reverses course in the second half of the year, that large cap underperforms the rest of the market?
No, I really think it's going to be more of a matter of being in the right sectors, the right countries, and we went into 2008, as you know, trying to avoid, as far as Russia, China, and India, as far as in the emerging markets, and avoiding the financials. And unfortunately, we'd say the same thing, avoid those areas. As far as small, mid, and large cap, I think there's values in all of them. If you're going to go large cap, I would go with the global leaders. Companies that we talked about a couple months ago, like Novartis, GlaxoSmithKline, and Sanofi of Venice, I think good dividends, historic lows. Novartis is the only one up about 10% from the last time we...
So we're seeing the biggest injection of liquidity in quite some time. Doesn't that set the stage for a better economy, better profits? I know it's awful now, I'm not denying that, but the stock market looks ahead 6 to 12. So are you ready to buy recoveries?
Yeah, I mean, some of the same areas we were warning about a year ago, we're starting to buy. I mean, where we were negative on Apple at 200 and Google at 700, at 85 and 330 respectively, they're starting to look interesting. I guess the main thing that worries me, Larry, is after the crash in 87, the day after, we talked with Sir John Templeton, and he gave us a whole list of companies that were trading near their net cash position. And I remember him distinctly saying that, Alan, I can't tell you if these, stocks aren't going to go lower because you're dealing with irrational behavior, investor emotion, but I can tell you 6-12 months from now, they're going to be higher. And I know a lot of the experts have been talking, are we in the 5th inning, 7th inning of this, credit crisis? What I'm worried about is that nobody told investors it's a doubleheader. And now that we're finally starting, instead of putting Band-Aids, starting to implement some things like you said, as far as injecting cash and what have you, instead of ignoring the problem, the damages as far as the economy, is so great that, I can't really say 6 months from now that, I know what Apple or Google, is going to earn, and therefore we're still putting in money, but doing it cautiously. I really thought we'd be putting in more money by now.
Alan, let me begin with you. Last week, you bought Goldman Sachs, JP Morgan, Wells Fargo, and GE. Talk about buying some stocks that have been absolutely clobbered, can we say? Any kind of word you'd want to use. What makes you think now is the right time?
Well, just purely on valuation, where a year ago, I think you were taking a lot of risk and you weren't getting rewarded for it, Aaron. I think now, as of late last week into that panic selling, there were just some tremendous opportunities. Not to say, it's a bottom or, no one knows, but I just think at those levels that you're getting an attractive yield, you're getting, valuations you haven't seen in years, and this is the upper echelon, the cream of the crop. And I think you want to buy quality when everything's gone down like it has.
Our first guest managed to steer clear of the tech bubble and its subsequent burst. He also avoided financials last year. Alan Lancz is editor and publisher of the Lancz Letter and director of research at LanczGlobal. He joins us in studio on this Friday. Good to have you with us.
Thanks, Carol.
I want to ask you, Alan, you did avoid a lot of bubbles in the past, including the financials. How come? What kind of kept you away?
Well, there's a number of things, I think. When you look at transparency, accountability, and greed, and those are all mixed together, it's usually an area or a time to be very careful.
But what specifically? What tipped you off that you were seeing kind of greed if you were within the financial community?
Well, the financials, what we saw is they kept on increasing their earnings, but it was how they were increasing their earnings. They were doing it by excess leverage. They're increasing their dividends. Unfortunately, that made a lot of conservative investors get in thinking it was almost like a utility or a safe investment, when actually they were taking more and more risk. And that's how bubbles are formed. As more and more people make money in those areas, more money flows to those areas, and those financial companies don't want to at least stop as far as the push of new money, just like they did with tech stocks, with new tech mutual funds, et cetera, et cetera.
All right, certainly a warning sign to you.